My name is Shahzad Malik, and I'm a partner in the corporate group and chair of the tax department at Stradling Yocca Carlson Rauth. In addition to representing lots of companies at an early stage, I often represent target companies in their liquidity events, whether it's a sale or an IPO. From my perspective, lots of value is left on the table by entrepreneurs because of poor planning at an early stage. To me, by far, the single most important consideration is a business's choice of entity. Significant value can be lost to foregone taxes or foregone value that the acquirer would have paid if the entrepreneur had made a different choice. There is no one right choice for everyone. The focus of this presentation is to get you to think about your choices and to understand them in the context of a liquidity event. Since you hope that your business is going to be profitable, you will need to focus on how you're going to lower your taxes on operational profits. Since you know your business is going to lose money in the early years, you also need to figure out a way to use these tax losses. Limited liability is also critical, as is flexibility in structuring ownership interests. Business deals vary a lot, and you need an entity that's as flexible as your business arrangement. Here's a list of the different types of entities. There's sole proprietorships, joint ventures, general partnerships, limited partnerships, limited liability companies, regular C corporations, and S corporations. A sole proprietorship is just a bad idea. A joint venture is useful only in very specialized circumstances, for example, where you have a business arrangement with someone in a foreign country. The only logical choices are an S corporation, a C corporation, or an LLC. In almost all cases, an LLC is going to be the best choice. An LLC is treated as a partnership for tax purposes, but it has limited liability just like a corporation. The value difference between an LLC and a corporation can be illustrated as follows. Intrepid entrepreneur starts a business with a $1 million initial investment. Within 2 years, Intrepid is able to sell her business for $10 million in an asset sale to Big Co. Don't we all wish we were Intrepid? If the business were a C corporation, Intrepid is going to first, the corporation is going to recognize gain on the sale of its assets on the difference between its basis of $1 million and the amount realized of $10 million. That's $9 million that's going to be taxed at a 40% rate. That's $3.6 million of tax at the corporate level. The remaining $5.4 million is distributed to Intrepid, who has $1 million in basis in her stock representing her initial investment. Her $4.4 million of gain is going to be subject to yet another 25% tax of $1.1 million. Intrepid has $4.4 million left of the $10 million in sales proceeds. That's not bad. I would certainly take it, but let's see if we can do better for our friend Intrepid. If the business were an LLC, the LLC would not be subject to any tax upon the asset sale. Instead, flow-through taxation would apply. Intrepid would be taxed at a 25% rate on her $9 million of gain. This would result in $2.25 million in tax. Intrepid has realized $6.75 million of the $10 million. That's $2.35 million difference in value. This is a very big deal. That extra $2.35 million may enable our friend Intrepid to retire and move to Tahiti to finger paint, whereas without that $2.35 million, she may have to work just like the rest of us. It is noted that our friend Intrepid could have avoided this tax if she'd sold the stock of her business, since if it was a C Corp, and avoided this additional layer of tax. However, Big Co is not going to pay the same amount on an asset sale as it would have paid on a stock sale, as it would have paid on an asset sale. The reason for this is that Big Co in an asset sale gets a $9 million step up in its asset basis and can depreciate that over time. That's very significant value for Big Co and a big part of why Big Co is paying the price that it is. Entity decisions matter, and that's why I'm doing this presentation. There are very limited circumstances where a C corporation or S corporation may make sense. The entity that makes the most sense if you think you're going to be acquired in a tax-free stock-for-stock transaction is typically an S corporation, because it can do a stock-for-stock reorg and it does not pay entity-level tax. However, S corporations are much less flexible in terms of the economics that are permitted than either an LLC or a C corporation. The only reason to be a C corporation early on is if you anticipate an IPO in the short term, since only C corporations are able effectively to do IPOs. Again, my name is Shahzad Malik. I'm a partner at Stradling. You can reach me at 949-725-4067 or by email at smalik@sycr.com. Stradling is proud to be a sponsor of TriTech, whose mission is to incubate and commercialize technology companies. Thank you.